Forget the margin hikes, forget the meme games, forget the paper silver price for just one moment. While Wall Street was busy rigging the casino last night, something happened in Seoul, South Korea that makes decades of banking manipulation look insignificant. Ladies and gentlemen, Asian guy here. We have now received technical confirmation of a breakthrough that doesn't just change the EV market. It reshapes the entire commodities landscape. For 10 years, bears told you silver was just a byproduct. Silver was abundant. Silver was finished. They said industry was moving away from it. They said efficiency in solar would kill demand. They were wrong, dangerously wrong. What I'm about to show you is the silver bomb. A single technological breakthrough that is mathematically guaranteed to consume the global silver mine supply within 3 years. We're talking about Samsung's solid-state battery. A 9-minute charge time, and the number bullion banks fear the most, 1 kilogram. That's how much physical silver goes into every single car. If you thought the solar squeeze was big, you haven't seen anything yet. Solar was the appetizer. This is the main course, and the table is already empty. Let's remove the marketing hype. Samsung SDI has teased solid-state batteries for years. So have Toyota, QuantumScape, Panasonic. It became a buzzword, but in late 2025, Samsung did what others couldn't. They confirmed mass production for 2027. This is no longer a lab experiment. It's a factory rollout. So what makes this battery different? The anode. Traditional lithium-ion batteries use graphite or silicon. It works, but it has limits. Slow charging, expansion, degradation. Lithium ions have to squeeze into graphite. Samsung removed graphite entirely and replaced it with a silver-carbon composite layer. Why silver? Because it's the most conductive metal on Earth. More importantly, silver forms a solid solution with lithium. During charging, lithium ions hit the silver layer, dissolve instantly, and form a smooth lithium metal surface. This prevents dendrites, the jagged spikes that cause battery failure and fires. This unlocks 3 things. First, energy density, 500 watt-hours per kilogram, double today's Tesla batteries. Half the size, half the weight. Second, range, up to 600 miles on a single charge. Range anxiety is gone. Third, and this is the killer, speed. A full charge in 9 minutes. Plug in, buy coffee, come back fully charged. Gas station speed. But physics has a price, and that price is silver. Now follow the math. This is what JP Morgan doesn't want you to see. Critics say the silver layer is thin, about 5 microns, so it can't use much silver. Wrong. Surface area is massive. EV batteries contain thousands of layered sheets. The total anode surface area equals roughly 2 football fields. Scientific papers behind this tech show silver loading of about 5 grams per amp hour. Scale that to a 100 kilowatt hour EV battery, and you get roughly 1,000 grams of silver per vehicle. 1 kilogram, 32 troy ounces. A Tesla today uses about 20-30 grams of silver. Samsung just increased silver use per vehicle by over 3,000%. This doesn't bend supply-demand charts. It breaks them. Now the adoption scenarios. Global EV production is projected to hit 30 million units annually by the late 2020s. Scenario 1, luxury only, 10%. 3 million cars equals 96 million ounces, 12% of global mine supply. Scenario 2, mainstream adoption, 20%. 6 million cars equals 192 million ounces, about 25% of global supply. Scenario 3, 50% adoption. 15 million cars equals 480 million ounces, over half the world's annual silver production. We only mine about 850 million ounces per year. Solar already uses 200 million. Electronics, 300 million. Jewelry, 200 million. Investment, 250 million. We're already in deficit. So where does the extra silver come from? It doesn't exist. Prices must rise enough to destroy other demand. Jewelry gets priced out. Investors get squeezed. Solar bids higher. Automakers win. They have the deepest pockets. Paying $200 per ounce adds about $6,400 to a $100,000 car. Painful, but manageable. Samsung won't buy futures or ETFs. They sign direct offtake deals with miners, Fresnillo, KGHM, Glencore, locking in years of production. This is why COMEX inventories are draining. Metal is bypassing exchanges and going straight from mine to factory. And it gets worse. China is moving now. BYD has unveiled 5-minute charging tech. Physics says that's impossible with graphite. Intelligence from Shenzhen suggests BYD is testing a hybrid solid-state battery using around 500 grams of silver per car. BYD sold 3 million EVs in 2024. Convert just 30%, that's another 16 million ounces. Full rollout, nearly 50 million ounces. Between BMW and BYD alone, close to 100 million ounces of new demand appears. And then there's Tesla. If BMW launches a 9-minute charging car, Tesla can't stand still. The 46680 battery uses graphite. It can't compete. Reports say Panasonic executives have been in Peru since late 2025, negotiating mine-to-factory silver supply deals. Panasonic is rushing a new battery platform for 2027. Higher range, faster charging. You don't get there with graphite. You get there with silver. Even 500 grams per Tesla across 2 million cars means 32 million ounces of new demand. This is a bidding war. Samsung versus Tesla versus BYD. And the prize is a tiny, finite pile of silver. The skeptics say, recycling will save us. That's a myth. These batteries are designed to last 20 years. Cars sold in 2027 won't be recycled until 2047. Recycling doesn't solve a crisis arriving in 3 years. By the time recycling matters, the silver market will already be unrecognizable. The 1 kilogram of silver inside that battery is locked away for 2 decades. It cannot be recycled because it is still actively being used. This is what's known as a stock flow trap. For the next 15 years, silver flows in only one direction, into vehicles. Nothing flows back out. Meaningful recycling from these batteries won't begin until the mid-2040s. But the demand is happening right now. So where does the metal come from today? It must come either from the mines or from existing private holdings. That's why the price cannot move sideways. It has to go vertical. The market must incentivize people to melt silverware, to sell coins and bars, because secondary supply from EV batteries is effectively zero for an entire generation. Another argument often raised is thrifting, that manufacturers will simply reduce silver content or replace it with copper. This is the solar panel argument. In solar, silver usage per panel was reduced dramatically, from roughly 500 milligrams to around 80 milligrams, through efficiency gains. But a battery is not a solar panel. In a solid-state battery, silver is not just a conductor, it is a structural host. The silver-carbon layer physically stabilizes lithium ions. Remove silver and lithium forms dendrites, metal spikes that cause short circuits and catastrophic failure. Copper doesn't work because it reacts with the electrolyte. Aluminum doesn't work because it expands excessively. Only silver works. Physics does not negotiate. You cannot remove silver from this chemistry without destroying the 9-minute charge time. And since that charge time is the entire selling point of the vehicle, it will not be compromised. The thrifting wall has been reached. Samsung needs the full 5-micron silver layer, making the 1 kilogram per car figure effectively permanent. This brings us to suppressed data. The Silver Institute, the official body tracking global supply and demand, has long been criticized for underreporting usage, often excluding military demand and quiet industrial stockpiling. However, information has surfaced regarding their upcoming 2026 interim report. In 2024, total demand was estimated at roughly 1.2 billion ounces. Leaked revisions suggest that for 2026, this figure is being raised to 1.5 billion ounces, a sudden increase of 300 million ounces. The footnotes reportedly cite unanticipated acceleration in automotive offtake and solid-state battery pilot programs. That means demand is quietly jumping 25% in a single year. We are already running an annual deficit of around 200 million ounces. Add another 300 million, and the deficit expands to 500 million ounces per year. Global mine production sits near 850 million ounces. That means we would be consuming roughly 60% more silver than we produce. There is no source for that extra metal. Vaults are depleted. Registered inventories are near 30 million ounces. Eligible inventories are effectively frozen. This is a mathematical impossibility. And when markets hit mathematical impossibility, prices don't rise gradually. They reprice violently. Now consider this from the perspective of BMW. Imagine you're producing a $120,000 luxury sedan, the solid-state i7. It requires 1 kilogram of silver. At $70 per ounce, the silver cost is about $2,250, a negligible fraction of the vehicle price. Even if silver rises to $200 an ounce, the cost becomes roughly $6,400, around 5% of the vehicle's price. BMW doesn't cancel the model. Compare that to retail investors. At $200 silver, most individuals won't be rushing to buy monster boxes. They may sell instead, but Samsung, BMW, Tesla, and BYD will buy. They can absorb $200 or even $500 silver because they pass the cost directly to consumers. That's why there's no meaningful price ceiling at $50 or $100. The real pain point for automakers likely begins near $1,000 per ounce, where silver costs about $32,000 per vehicle. Between $70 and $1,000, the road is wide open. If battery technology were the only factor, silver might reach $100. If industrial shortages were the only issue, perhaps $150. But there is a third pillar that turns shortage into an extinction-level event: war. While analysts focused on battery chemistry, a different signal began flashing in Washington, D.C., one that preceded the Gulf War, Panama, and Ukraine. It's not a stock chart or satellite image, it's pizza. The Pentagon Pizza Index is a real phenomenon. When senior military staff work overnight planning operations, pizza orders spike. Delivery drivers in Arlington have reported this pattern for decades. On December 22nd at 11 p.m. EST, the index didn't just spike, it broke. Reports indicate drivers were turned away due to volume, and the Pentagon lights stayed on all night. Hours later, news broke that Russia was evacuating diplomats' families from Venezuela. When a superpower pulls civilians from a proxy state, kinetic action is imminent. While Venezuela itself doesn't produce much silver, its neighbors do. Peru and Chile sit directly in the affected corridor. If conflict escalates and the Caribbean or Panama Canal is disrupted, South American silver supply lines are cut. Peru is the world's third largest silver producer, and Chile is a major copper-silver supplier. If those routes close, Samsung, Tesla, and Panasonic lose access to critical metal. And then there's the most dangerous competitor for silver, not automakers, but the military. A Samsung EV requires 1 kilogram of silver. A single Tomahawk cruise missile is estimated to contain roughly 500 ounces, or 15 kilograms, of silver in its guidance systems, contacts, and high-performance batteries. At hypersonic speeds, failure is not an option. You don't use copper in weapon systems, you use silver. In 2024 and 2025, U.S. missile stockpiles were depleted through deployments in the Red Sea, Ukraine, and Taiwan. With new geopolitical flashpoints emerging, the Pentagon must restock. Thousands of missiles multiplied by hundreds of ounces each translates into millions of ounces of strategic demand. Now the silver market faces a three-way battle: consumer demand from EVs, strategic demand from defense, and monetary demand from investors. In that hierarchy, the Pentagon comes first. Through the Defense Production Act, it can prioritize supply and redirect inventory. But the U.S. lacks sufficient domestic silver mines and relies heavily on imports, primarily from Mexico. Mexico is the world's largest silver producer, often called the Saudi Arabia of silver. For decades, it exported freely. But political winds are shifting. Resource nationalism is rising across Latin America. Mexico has already nationalized lithium, and proposed legislation now targets strategic metals, including silver. From their perspective, if every EV requires 1 kilogram of Mexican silver, why export it cheaply? Why not build the supply chain domestically and retain the metal? If Mexico imposes an export ban, similar to Indonesia, nickel policy, or China, gallium restrictions, the North American silver supply chain collapses overnight. Samsung cannot build batteries without Mexican silver. Panasonic cannot build without Peruvian silver. We are one executive order away from a full-scale supply shock. From Samsung's perspective, the risk is existential. South Korea has virtually no domestic silver production. Nearly all raw materials must be imported from Mexico and Peru, shipped across the Pacific to factories in Korea and Europe. If the Pacific becomes a contested zone, through tensions around Taiwan or expanded Russian naval activity, shipping insurance explodes and deliveries stall. That geopolitical risk has not been priced into silver yet. And that is the final piece of the puzzle. If shipping lanes are blocked or even slightly disrupted, Samsung's factories immediately begin to starve. Samsung operates on a just-in-time inventory model. They do not keep years' worth of silver sitting in a vault. Well, they have barely 2 weeks of supply. That vulnerability is exactly why Samsung is panic buying right now. They are trying to move physical silver onto Korean soil before the war begins. This is why we are seeing heavy premiums in Asia. Silver is trading near $74 in Shanghai and Seoul, while it remains around $68 in New York. Asian markets are pricing in war risk. American markets are still pricing in a Federal Reserve pivot. One market is awake. The other is asleep at the wheel. When you combine all these factors, the picture becomes far more dangerous. There is technology demand. Samsung needs 1 kilogram of silver for every car. There is war demand. The Pentagon needs roughly 500 ounces of silver for every missile. And layered on top of that is geopolitical risk, with Russia, Venezuela, and Mexico all threatening critical supply lines. Commodity traders have a word for this type of situation: unobtainium. It means a material that cannot be obtained at any price. If Samsung has 10,000 workers sitting inside a factory waiting to build batteries, and the silver shipment does not arrive, the company loses billions of dollars. That is why companies are ignoring the exchange price. They're going directly to the private market. Calls are being made to Glencore, Trafigura, and private vaults in Zurich. The message is simple. We don't care about the COMEX price. We don't care if it says $68. We will pay $150 right now. Put the silver on a plane. This is the dark market, and it is operating right now. While you watch the price on a screen, the real transactions are happening off exchange. Samsung, Tesla, and Raytheon are all locking in supply at $100 plus. The only people still focused on the screen price are retail investors. History points in the same direction. During World War II, silver was so critical to the Manhattan Project that the U.S. government removed 14,000 tons of silver directly from the Treasury without payment. Why? Because without silver, you cannot win a war. We're entering another era where silver is no longer just money or an industrial metal. It is a strategic asset. Missile guidance systems, electric vehicles, and solar energy all depend on silver. China and Russia have been hoarding silver for years. The United States sold its strategic stockpile decades ago. Today, the U.S. has effectively zero reserves, and policymakers are beginning to realize how catastrophic that decision was. Now look at the retail market. People are asking a simple question. If silver is $68, why can't I buy it for $75? Orders are being canceled. Phones are not being answered. Premiums have surged to 60%. The problem is not just supply, it is counterparty risk. Coin dealers do not operate like grocery stores. Their margins are razor thin, typically 1% to 2%. To survive, they hedge their inventory by buying physical silver and shorting futures on COMEX. But when the CME doubled margin requirements, dealers were hit with massive margin calls. They did not have the cash. Their hedges were liquidated, leaving them completely exposed. Now dealers are trapped in a financial no man's land. If they sell silver and prices fall, they go bankrupt. If they sell silver and cannot replace inventory, they are finished anyway. That is why buy buttons are turned off and phones are silent. Sold out does not mean the metal does not exist. It means the system has frozen. Paper products like SLV are even more dangerous in this environment. The silver inside SLV does not belong to you. Only authorized participants, JP Morgan, Citi, HSBC, are allowed to withdraw physical metal. In a crisis, those banks redeem shares, remove the silver, and leave retail investors with cash settlement at the COMEX price. On the street, silver could be trading at $150 while you receive a check based on $75. This is legal. It is written into the contract. Unallocated silver accounts and digital silver are even riskier. If you do not have a serial number tied to specific bars, you do not own silver, you are an unsecured creditor of a bank. In a systemic failure, bail-ins occur, like Cyprus in 2013. The bank takes your silver, sells it to survive, and hands you worthless equity instead. This is why the saying exists. If you don't hold it, you don't own it. The most confusing part of all of this is psychology. Current data shows roughly 20 sellers for every one buyer. People are exhausted. They bought at $30, waited for years, and now see $68 as an exit opportunity. This is weak hand capitulation. It is exactly what banks wait for. Retail investors sell, refiners melt the metal, and silver flows to industrial giants. Historically, when the public sells at a 20-to-1 ratio, that marks the final bottom. You're also going to hear one phrase repeatedly in the coming days: force majeure. Mexican miners are preparing to invoke it, citing geopolitical instability and regulatory changes. Once force majeure is declared, the entire supply chain stops. Miners, refiners, mints, dealers. At that point, the price of silver becomes theoretical. It does not matter what the screen says. You cannot buy it. Millions of buyers, zero sellers. That is unobtainium. The final takeaway is this: if you cannot buy physical silver above ground, the solution is below ground: mining stocks. When the paper market breaks, mining equities become the last functioning free market. And right now, they are flashing one of the strongest buy signals in history. Silver is up roughly 140% year to date, yet most mining stocks are only up 80% to 100%. The question is, why? The answer is simple. Wall Street hates miners. Mining is viewed as dirty, risky, and capital intensive. Because of that bias, mining companies are still being priced as if silver were stuck at $30. But the math Wall Street is missing is extremely powerful. If a miner's cost to pull silver out of the ground is $20 per ounce, then at $30 silver, the profit is only $10. But when silver moves to $70, that same miner is making $50 per ounce. Silver's price only moved 2 and 3x, but the miner's profit increased 5x. This is called operational leverage. And if silver reaches $100, the miner's profit jumps to $80 per ounce, an 8x increase in cash flow. This is why in 2026, mining companies could become the most profitable businesses in the S&P 500. They could generate more free cash flow than companies like Apple. And because miners are the only source of new silver for Samsung and Tesla, they effectively hold the keys to the kingdom. For investors who are uncomfortable with mining risks, such as mine collapses or government nationalization, there's a safer alternative: royalty companies. A prime example is Wheaton Precious Metals, WPM. These companies do not operate mines. They do not dig holes, run trucks, or deal with labor unions. Instead, they provide upfront capital to miners in exchange for the right to purchase silver at a fixed price forever. Wheaton holds contracts that allow it to buy silver for roughly $4 to $6 per ounce, permanently. Think about that. When the market price is $68, Wheaton is still buying silver at $6. They do this every single day. That is why WPM functions like a cash printing machine. And because royalty companies have no exposure to fuel, labor, or energy costs, they are largely immune to inflation. If physical silver coins are unavailable, owning WPM stock is like owning an endless stream of silver. It is the safe haven of the equity market. However, if you want maximum leverage, if you want to turn $10,000 into $100,000, then you need to look at primary miners, the companies with the largest silver reserves still in the ground. When we track the data, two names stand out. The first is First Majestic Silver, AG. This is one of the purest silver plays available. The company hoards its own silver and refuses to sell it cheaply. It even operates its own bullion store, which is currently sold out. The stock behaves like a call option on silver. If silver reaches $100, First Majestic could trade near $100 as well. The second is Hecla Mining, HL. Hecla operates the Lucky Friday mine in Idaho, one of the few large silver mines located inside the United States. That matters for one reason: strategic security. If Mexico bans exports or Peru becomes blockaded, Hecla remains within U.S. borders. The Pentagon will protect it. The U.S. government will buy every ounce it produces. This makes Hecla a national security play. Owning these stocks is not just an investment. It is a claim on future silver supply, the exact supply Samsung desperately needs. So where does this end? What is the final price? We have said before that $70 was only the beginning, and that $100 is where banks start to feel pain. But with the new data showing 1 kilogram of silver per EV, the target must be revised higher. If every electric vehicle requires silver and demand is inelastic, meaning manufacturers will pay any price, then silver must rise until it forces other buyers out of the market. At $100, does the solar industry stop buying? No, they still need silver. At $120, do investors stop buying? No, that is where FOMO begins. The price must rise high enough to trigger large-scale recycling and jewelry liquidation. We estimate that pain point lies between $150 and $200 per ounce. At $150, people begin selling inherited silverware and family tea sets. That is the level where supply and demand finally rebalance. That is why our official 2026 target is $150. And remember, back in 1980, silver moved 5x in just 2 months. When silver moves, it does not walk, it teleports. Now I want to speak directly to those who have been with us since $20. The ones who stacked when people laughed. The ones who held while the price was smashed. You were right. They called silver a pet rock. They called it a barbarous relic. They said crypto was the only future. But today, December 23rd, 2025, looking at empty vaults, desperate banks, and panicking industrial giants, the truth is clear. Silver is not just money. Silver is technology. Silver is energy. Silver is freedom. The wealth transfer we have discussed for years is not coming. It is already here. The banks cheated last night because they lost. They changed the rules because they lost. They broke the market because they lost. You won. You hold the asset they need. You hold the collateral of the new world. So do not sell. Do not panic at $60 or $70. Do not let them steal your victory. Hold the line. Watch the miners. Watch Samsung's moves. The era of paper manipulation is ending. The era of real price discovery has begun.